Right, hi guys, welcome to the live stream. My name is Zahir Anwari, co-founder of Sublime Trading. We help investors and traders alike get consistent returns in the stock market using a proven long-term strategy and in less than 30 to 60 minutes a week. Okay, so an emergency update on the S&P 500. We had a significant move to the upside, which I am going to be breaking down in this stream, having a look at the S&P 500 as well as the Dow Jones and the Nasdaq, and have a look at what this could mean for the stock market as a whole through the rest of 2022 into 2023. We know 2022 has been a difficult year. The S&P 500 correcting around 25%. However, it seems to have found some kind of support level, and we are now starting to see a move to the upside. And if that move holds, it could be very significant in terms of the market conditions that we will be in through rest of 2023. Now, there aren't any guarantees, but we need to be prepared for what the market may have for us ahead. Okay, guys, if you have any questions, do put them in the chat box and I will be happy to go through them. Any stocks as well, or any charts that you want me to analyze, I will be happy to do that as well. Okay, so let's jump into the chart setup that I have here. This is a typical chart setup of mine. This is a three-screen setup, monthly in the top left, weekly in the top right, and the daily time frame across the bottom. Now, I am known as what is called a trend follower. I'll wait for the market to dictate a direction, and then I go in that direction. These are known as trends. Once a trend has been established, I simply jump on the best looking stocks in that direction, and I have those in my portfolio. Typically hold for 12 to 24 months, compounding along the way. Once the market shows some kind of reversal, I take my profit, usually with a trailing stop loss, and then I repeat that process again. It's very simple and it's very suitable for busy everyday people. You got to remember, guys, that we're everyday people. You guys on here, you'll have jobs, you'll have careers, families, hobbies, social life. What you want is a style of trading, style of investing that has your money working for you in the background, which will allow you to get on with your life and do what you need to do. It's complete empowerment here. What you don't want is a life glued to the screen as a day trader, because first of all, it's not really a life. You and candlesticks, it's not really a life. Secondly, there's no money in it. Day trading, day trading is a proven wealth extraction mechanism. It's not a wealth creation mechanism. Day trading is a proven wealth extraction mechanism. The sooner you realize that, the better. Okay, you need to always stay true to the long-term principles of investing, which is to play the long game. Okay, so let's start with the analysis. Let's get into our setup. We've got a three-screen setup here. We've got the monthly in the top left, the weekly in the top right, and the daily time frame across the bottom. So this is what I mean, guys. Because I'm looking at the big moves in the market, I need the time frames to allow me to do that. So I always start with the monthly, I then move to the weekly, and then come down to the daily. What I'm looking for is all three time frames to be moving in the same direction, either bullish or bearish. If there's a mixture of bullish and bearish factors, I stand aside. So let's start with the S&P 500. If we look at current price action, this is the correction that we've had this year. Now, what's interesting about this correction is that it's remained between this level and this level. This is the highest point of 2021. This is the lowest point of 2021. In a bull market, ideally, I want to see price above the high of last year, and in a bear market, below the low of last year. If we look at the S&P 500, it hasn't gathered any momentum below the low of last year. We had a break and a close below this level in September. But if we look at October, complete reversal, and November, that momentum's continued. Price also closed above the 4,000 round number. If you look at the current price, it's 4080, roughly around that level. So it closed above 4,000. It's significant. This means that the market is looking to push to the upside. Now, this isn't a guarantee. This could be a fake out where the market shows a temporary move and then a bounce and then a drop back to the downside. That, of course, could happen, which is why we still want to apply a bit of patience. But there is a strong chance that the market is looking to move to the upside. Now, let's look at the weekly time frame. If I compress the weekly time frame, since 2010, let me get rid of that. Since 2010, which is this point here. So we had the bear market of 2000 to 2002. We had the bear market from 2007 to 2009. Notice both those bear markets broke through the 200 moving average, which is the black line. We had to break through the 200 moving average. We had to break through the 200 moving average. At this point here, in 2010, the market moved above the 200 moving average, came back to retest it in 2011. And since 2011, the market has been bouncing off the 200 simple moving average. We can ignore this because this is Corona, and Corona was a black swan event. Usually, black swan events, they have some kind of impact, quite a lot of impact in the case of the coronavirus, some short-term impact, couple of months, and then the market found support and started moving back to the upside. So if you look at the move from 2011 to the high point here, that's a 95%, 94, 95% move to the upside. And then the market came back to the 200 simple moving average. From the 200 simple moving average to this high point here, you're looking at a move of around 60, 61% before a move to the 200 simple moving average. And then if you look at the move from there to the current all-time high, you're looking at a move of around 104%. And then the market came back. And look at where it is right now, guys, the 200 simple moving average. So the market has a pattern of repeatedly sort of bouncing off the 200 simple moving average. And that is why this is not a full-on bear market. A bear market is rarely like we saw in 2000 to 2002 when price broke through the 200 moving average on the weekly, the 200 moving average between 2007 and 2009. Those are bear markets. This year, we've not had a bear market. We've had a pretty deep correction. And it's not only because of how far price had moved away from the 200 simple moving average that we've seen quite a deep correction. But since October, the market is moving to the upside. Now, I'm not going to be getting into the market until the trend filter turns green. So you'll notice that I've got periods of green, periods of red, and periods of gray. What I'm looking for is my trend filter to turn green above the orange line, which is the 50 simple moving average. Similar sort of setup post coronavirus. This is the drop in price around coronavirus. Then we had a correction, and then it was around July where the trend filter turned green, and then we had this nice clean move to the upside. So that's what I'm looking for. Similar sort of setup. I want to see the trend filter turn green above the 50 simple moving average, the orange line, and that's when I will start buying into the market. Now, what's significant on the daily time frame is if you look at yesterday's price action, big move to the upside, around 3.3%, the market closed above the 200 simple moving average. This is a strong sign, again, that the market is looking to push to the upside. Now, it's still a little bit too early to jump in the market. The reason why I say it's a little bit too early is because if you look at this move here, back in March to April of this year, we had a move above the 200 moving average, which is the black line. Market found resistance, and then it went on this big decline. We then had a pull back to the 200 simple moving average. The market didn't close above it. It found resistance pretty much spot on the 200 moving average, and then we had another drop. If we look at what's happened this time around, the market's moved back to the upside. It's closed above the 200 moving average, which is significant. But it's not a guarantee that we're going to see strength just because of what we saw back earlier this year. So how do we avoid this situation? How do we minimize getting caught up in a fake out? Well, what we want to see is a move, then we want to see a pullback, and then we want to see a move back to the upside. And once we get that set up, and remember this here will be what the 200 moving average will look like. We want to see a move to the upside, a pullback, and then another move to the upside. What we want to try and avoid is, I'll just get a red pen. What we want to try and avoid is a fake out. And that's where the market comes back to the downside. Just like we saw here, there was a fake out and the market reversed back below the 200 moving average. So by applying a bit of patience and waiting for this, what we call a bull flag formation, ideally move, pullback, breakout, and then we can start getting into these positions, we avoid getting caught up in a fake breakout. I hope that helps, guys. Okay, if you want any clarity on what I'm saying here, or if you have any sort of questions, do put them in the chat box. Okay, now let's move on to the Dow Jones. The Dow Jones is very much leading the way. If you look at the Dow Jones, we can see a good move to the upside. You can see it's trading above the low of last year. Of course, still below the high of last year, but that's okay. We are seeing good momentum to the upside. If you go to the weekly time frame, if you look at current price action, the trend filter is already green. It's above the 50 and the 200 simple moving averages. If you go back to the S&P, we can see the S&P is still below the orange line. The S&P 500 is really our primary indicator. So even though the Dow Jones is leading the way, the S&P is what really dictates our decisions. So once the S&P has the same setup as the Dow Jones, which is this setup here, the trend filter is green above the 200 simple moving average. That is when we will start considering long positions. And if we come down to the daily time frame, okay, now if we just go back to the S&P, we can see the S&P has only just broken above the 200 moving average. That was yesterday's price action. If you look at the Dow Jones moved above the 200 moving average at the end of October, dropped below it temporarily, came back above it at the start of November, and has remained above it since the start of November. And if you look at yesterday's bar, again, a strong bar that closed above the high from August. So there's these little indicators in the market that are suggesting that we could potentially see further strength to the upside. When you start seeing key levels, these sort of ceilings, also known as resistance levels, when they start getting broken and the market's moving to the upside, it's a strong sign that the market is recovering, and why this time it could be different to the previous fake runs, if you like, to the upside that we saw. So the Dow Jones is looking very, very strong. The Nasdaq, of course, is very much lagging behind. We know that tech stocks have taken a real dumping this year. PayPal, Tesla, Microsoft, Apple, Nvidia, all of these giant tech companies, their stocks have taken a bit of a beating. The company itself is still healthy. These are all still giant companies, but the stock doesn't necessarily reflect the company. And this is why you don't want to trade A, the brand name, and B, undervalued stocks. You don't want stocks that are dropping in price hoping that they will reverse, because the likelihood of them just dropping or remaining and going sideways at these low levels is extremely high. What you want is to be waiting for the market to dictate a direction. Once you've got that confirmation, using the S&P 500, once you've used the S&P 500 to dictate a direction, then look at the sectors, look at which sector is the strongest, and then look for the strongest stocks in the strongest sector. And that way you will have the stocks that are performing better than the average. And that way you will get better than average returns. Remember, the indices are averages, guys. The S&P is an average of 500 stocks. If I can find the stocks that are performing better than the average, then that is how I will get better than average returns. The tech sector took a real beating. Why? Well, I mean, it had an extremely good run post coronavirus. Everyone was online, and maybe that was an influence as to why the tech sector did so well while we were in lockdown. But post lockdown, it's taken a real beating. And if you look at where current price action is, it's still trading below the lowest point of last year. You go back to the Dow Jones, it's very much above the lowest point of last year. Go back to the S&P 500, it's above the lowest point of last year. The Nasdaq, even though we're seeing a bit of recovery coming in, it's still below the lowest point of last year. If it moves above this, then it's an alignment with the Dow Jones and the S&P, and that's when we are likely to see further strength. Okay, if you go to the weekly, it's above the 200 simple moving average, below the 50 simple moving average. We want the trend filter to turn green above the 50 simple moving average. And if you come down to the daily time frame, good move to the upside yesterday, but still below the 200 moving average. Again, if you go to the Dow Jones, very much leading the way, really strong move to the upside. And if you go to the S&P 500, it closed above the 200 simple moving average. The Nasdaq is very much lagging behind. Now, with the S&P 500 increasing in price and the Dow Jones increasing in price, the Nasdaq is very likely to follow. But that doesn't mean to say that you want to get obsessed with tech stocks. It's not how to make profit. The way to make profit is to look for the strongest stocks in the strongest sectors. What I tell people is to invest in the right stocks at the right time using the right strategy. Yeah? Invest in the right stocks let me say that again. Invest in the right stocks at the right time using the right strategy. If you use that formula, if you use that formula, what we mean by right stocks is high probability stocks. Stocks have the highest chance of returning your profit, regardless of their brand name. And this is where people tend to go wrong. They get obsessed with brand names, obsessed with Tesla, obsessed with people like Elon Musk. Great guy. I have no problem with Elon Musk, but Tesla, I mean, let's just have a quick look at Tesla. Tesla is not a good stock. And of course, Twitter as well. If you have a look at Twitter, it's not a good stock. So let's just have a quick look at Tesla. I mean, it's really not a good stock. If you compare it to, say, McKesson, which is in our portfolio, you see McKesson is up 60%, while Tesla has been dropping. So these are the kind of stocks you want to be looking for. Again, the strongest stocks, the right stocks in the right stocks from the right sector. You want to invest in them at the right time using the right strategy. Okay, and this is where your analysis comes in. Maybe scanners come in. You know, it's important to have the right equipment, the right tools. And you can see that we've developed a tool here. We use TradingView, which is a fantastic platform. It's online, it's browser based, excellent price. I mean, you know, there's a lot of very expensive packages out there that don't do half the stuff that TradingView does. So TradingView is an excellent package. It allows you to really personalize the platform to your requirements. And so the tools that we've developed really help with narrowing down to the best looking stocks. Now, if you look at this, guys, look at the weekly time frame. Look how well McKesson has been trending. The 50 simple moving average angling up, the 200 simple moving average angling up. We go on the daily as well. You can see a really nice, clean trend to the upside. Yes, sometimes we have bits of red, but that can happen. Overall, though, it's been moving very, very nicely to the upside. Again, let's have a look at Twitter. I'm looking at these stocks just simply because you guys don't want to be getting caught up in these stocks. If you look at Twitter, it's just gone nowhere. It's just whipsawing. Yes, we're seeing some bullish momentum come in, but we know from history that these are sort of short-lived. If it moves through the highest point of 2021, then this will start looking more interesting. But as long as price remains within this sort of consolidation market, you really just want to be standing aside. There are a lot of good-looking stocks out there. Here's a stock that's in our portfolio, DE. Deere and Co. This is probably a stock you haven't heard of. You can see, first of all, why it was in our portfolio post coronavirus. We've held through this period of consolidation, and we're now starting to see strength to the upside. If it breaks out, and well, how far could this go? Well, $1,000 is not uncommon. Stocks do reach those levels. You just have to look at Amazon, look at Nvidia before the stock split. These sort of levels are very, very achievable. Once it breaks out, we'll keep on buying more of that compounding. Okay, so this is what you want to be doing. You want to be, first of all, establishing market conditions using the S&P 500. Once the S&P 500 has confirmed the direction of the market, you then want to be doing an analysis that looks at all the sectors and then narrows down to the strongest stocks in the strongest sectors. You do that using scanners and tools such as the ones we've developed. And then once you've done that and you've shortlisted the stocks you want to buy, you then need to have a strategy to buy those stocks. So strategy involves entry points, stop losses, risk management, typically no more than 1 to 3% per position, your target levels, compound levels, trailing stop losses. It's simple, guys. It's all very, very simple to learn, but people tend to overlook the sophistication that comes with it. There's an expression which is good trading and good investing is simple, but not easy. What that means is that the best techniques are simple to learn, but following that strategy and that process day in, day out, week in, week out, month in, month out, year in, year out is where a lot of people fall short. And the reason for that is because they're always chasing money. Don't chase money. Let the money come to you. Okay. So, guys, that was a quick emergency update on the S&P 500. My stance for now, still standing aside. I want to see how particularly this week ends. Tomorrow is Friday, of course. And we also have NFP out on Friday. So let's see how NFP impacts the market. And then we'll keep an eye out on the stock market for the rest of 2022. I will be doing regular streams like this. So if you have any questions, do reach out to me on direct message. And I can happily go through those questions on the live stream. Okay, guys, have a lovely rest of the day, and I will see you on the next live stream.